Life insurance corrects a lot of mistakes that you have made and you will make into the future.
I think it's one of the greatest financial tools ever created to store your wealth.
Absolutely.
Instead of storing cash in a bank, you could store your cash in a whole life insurance policy, receive a dividend on it, and still get access to it without having early penalties, without paying tax on it.
You know who made it.
Welcome back to the Wealth Eazy Show, where we talk all things wealth, health, and real estate. Today, I have a very special guest. My guest is a veteran in the life insurance industry, having started his career in 1981. Having spent most of his years building his private practice, he now spends his time training advisors. As vice president of IDC World Source, he's delivered over 1,000 seminars and workshops and is now a mentor in the Circle of Wealth software. Please welcome to the show, Don Hart. Don, thank you for being here.
Thanks very much, John. Always a pleasure.
Thank you. What have you been up to lately? Because I know we've been doing some things, some seminars and whatnot together. And
Yeah, I've been editing those seminars actually because we got some video, as you know, from Don Blanton at the golf course. So I've been doing some editing of some videos, some training videos, those kinds of things, helping a couple of sales. I was out on a joint sales call in London, Ontario a few days back. Did a nice sale. We've been working on that for a while, and we've got another one coming up. Nice premium for a whole life sale. So you'd be proud. You'd be proud.
So you're spending a lot of your time right now. You're not doing the personal stuff. You're actually coaching advisors, and you're helping facilitate the larger transactions with advisors who may not have the experience to go into a large case sale.
Yeah, you know, funny, John, it's more not even experience. It's about confidence, as you know. I mean, it's all about confidence, and they've been at it for 20 years. Some of the guys I go with have been at it 20 years, 22 years, some 5 years, but most of them are 16-year or more veterans. And they've been used to asking a certain set of questions of their clients, and they know there's more opportunity there for their clients and for them. But they just don't know how to crack the nut. They just don't know how to get by the biases they have and the biases their clients have to get over that hump to make it come to, get it across the goal line.
I always say you don't know what you don't know.
You don't know what you don't know.
And then you don't know what you think you know.
Well, what you think you know might be not true, as we know.
You've been in this business now more than 40 years.
Yes.
How has the life insurance industry evolved over the last 40 years? What have you seen? Any trends?
You know, it's funny. Not much has happened in the last 35 of those 40 years. It's pretty steady Eddie. You know, one of the things when I came in the insurance business, there were 150 insurance companies out there. And I was at an Avacus or one of these, industry seminars, and they said, 5 years from now, there'll be 50 companies left. And 5 years later, there was 50 companies left. And today there's probably about 10 that we would think of. And it's kind of funny how the consolidation of the companies like Garing Global, Seaboard Life, Toronto Mutual, Confederation Life, a bunch of companies have been absorbed by the bigger companies, and they'll stand the test of time just because they're so big. It's like that, too big to fail. They're so large and they have such big par funds behind them. There's so much money behind them that, they're going to be here for a long time. There's some marginal players or peripheral players, but the big players are going to be here for a long time. So the biggest change I've seen is the consolidation of the businesses. And then COVID changed it dramatically. Like non-evidence maximums have gone way up. Before you couldn't get a life insurance policy without a blood test at $250,000. Then it was preferred.
Now it's like $1 million.
It's 3 million. You'll go to 3 million today without a blood test or urine test, depending on your age. But back in the day, you were trying to get preferred rates when preferred underwriting came out, and you had to submit to a urine and a blood test to get preferred rates, because then they could see inside you, right?
Right.
And so now you don't even need that blood test or urine test, because they have AI, and what AI came to us with was all the analysis of all the numbers.
Right.
And they know the odds of you having something and me having something, and they can make a decision based on those odds, based on our ages, based on our height and our weight.
Now, do you think a lot of the information is actually coming from the physicians because even though they may not need a blood test or a urine test, there's still an APS, which is an attending physician statement, and they're getting a lot of the information from that state or the medical board.
Yeah, they're getting it from their doctors, so they're going for APSs, and they're trying to waive the APSs as much as they can as well, because doctors are very slow at getting those things done, as you know, again, right? And it doesn't matter how big the client is or how much money they have, it's still slow. Because the doctor makes between $250 and $300 to get that APS done, and it takes him about 45 minutes to do it. And he probably doesn't do it, or she probably doesn't do it. It's somebody in the office that's putting the file together. She just looks it over and says, yeah, okay. Now, I don't know that to be true, but I'm just saying, if I could see 10 people in the hour and make $250 a person, as opposed to taking 45 minutes to an hour to do an APS, I'm seeing as many people as I can in an hour. Yeah. So that's kind of what's going on out there a little bit as well.
And are you seeing the consolidation, big banks coming in and buying insurance carriers?
You don't see too much of the banks coming in anymore. That's slowed down a little bit. I mean, there might be a play going on in the background, but they distribute carriers products. So what's happened is, like TD Bank will distribute Canada Life. They're high-end people. The high-end people in the RBC Wealth division will be using other carriers' products to distribute to their clients. Because once you have the money, you have the client. And the bank has the money. Like, they have their accounts, they know where the money is, and they just start farming that money through their high net worth section, right?
Right.
Their division.
So here's a question. Banks don't usually offer life insurance. They offer mutual funds, their products.
Right.
Why do you think that banks don't get involved in selling life insurance like they do their mutual funds or their CDs or their GICs, whatever?
Yeah, because exactly what you said. They don't sell it. They don't have salespeople. And life insurance is an anomaly. Life insurance is sold. People aren't sitting at home right now thinking about, I got to go out and buy $2 million of life insurance, or I should put $300,000 into a whole life insurance policy. They're not thinking that. Mm-hmm. They are thinking about, I wonder where I can get the best performance on my mutual fund. I wonder where I can put my money to get the best high interest savings rate. It's a commodity, and it's a bought commodity. What the banks sell are commodities that are purchased. TFSA, RRSP, money portfolios, investment portfolios. Life insurance is, you got to have somebody in front of them that knows the product inside out, knows how it can benefit the client, and can talk about it in a way that the client wants it. Mm-hmm. Once you get life insurance into a want position as opposed to a need position, you start selling crazy amounts of it, because you make it so attractive that the wealthy people can't see not having it. And a lower income person says, I don't really want to buy life insurance. I don't want to leave my family with more money than they have now, or I don't want to leave my wife rich or my husband rich. So it's a mindset that you've got to overcome to get into that spot where it's a want product and a love product. People buy life insurance because they love themselves or love somebody else. Here's a question for you, John. If you could spend all the life insurance on your life now in advance of your death, how much life insurance would you like?
As much as I can get.
Absolutely, every time. But if you ask that of a client, of an average income kind of person, they'll say, well, I don't want to buy more than I need, so just give me a small amount of term insurance. I'll take $500,000, thinking that $500,000 is a lot of insurance. $500,000 of insurance doesn't last very long today.
Hey everyone, it's John. I just wanted to thank you for being here, and I would ask that you please subscribe to the show by just clicking the subscribe button right here. I'd really appreciate it. It helps grow the show so we can get even more successful guests on the program to help you. If you're already subscribed, a huge thank you. When you subscribe, you're going to get access to the program before anybody else does. So if you would, just click subscribe right here. Thanks so much, and welcome back to the Wealth Eazy Show. You actually just said something. You said they look at a lot of this as an expense because it's
Correct.
cheap. The problem with that mentality is it's not an expense. If you want to talk an expense, try dying without it.
Yeah, well.
And see what expenses your family has now that that income is no longer there, right? So it becomes, I always say, and you said it too, it's a love product.
Yep.
And it's not a need product, it's a want product, because at the end of the day, if you knew you were dying tomorrow and your family needed your income,
Yep.
how long do you want your income to last for? At 15, 20, 25, I want it to last for as long as possible. So let's take a look at how much are you currently earning? Let's multiply that by 10 or 25 years. If you're 30, let's multiply it by 30 or 35 years. That's how long you want your income to get. That's how much life insurance that you want. Is this what you're telling me you want for your family? Yes. So you're right. It's a love product because you always have someone in your family that you love. It's not really for you unless you're buying whole life insurance. Now we show you how it could be for you and you become the beneficiary and you can actually use those benefits throughout your lifetime.
Well, it also becomes a permission slip to spend those other assets in your retirement phase, right?
Correct.
The one thing about life insurance, particularly permanent insurance, it needs time. There needs to be time on its side. So you buy it early and buy as much as you can, as much as you want, as early as you can, as early as possible, because then time's on your side. So you need a compound line. If you're 79 years of age and now you want some permanent insurance because you want some burial insurance, you're not going to buy a lot. And you're going to buy universal life, and it's going to be a level death benefit for the funeral. It might be a capital gains tax problem if it's an ultra wealthy person. Then it's a conversion maybe of some term insurance to whole life, and then it's permanent insurance, and it still might be UL at that point because you don't have the compound line on your side. It's every time you put $1 in now, it's got a shorter span of time between you and your death date, right? Your what's the expiry date?
Yes.
Your best before date.
Right.
Right.
Exactly. So there's this common idea out there of buy term, invest the difference.
Yep.
Dave Ramsey pushes that theory. A lot of guys who work for Primerica, I get a lot of people, oh my God, I can't. If I showed you the amount of DMs I get from Primerica guys telling me that I'm complete full of shit, that I'm ripping off my clients and that they should buy term, invest the difference.
Right.
Why is that not a great strategy?
Well, because I think it's less than 1% or maybe 1% of people die with term insurance on their lives.
Correct.
If you could tell me, hey, listen, term insurance is a great deal. If you could tell me the exact day you're going to die, I tell you the day you should buy term insurance and how much you should buy, right? Because I could tell you the day before you're going to die is the day you should buy the term insurance and buy as much as possible. But you don't know when you're going to die.
Correct.
But the one thing is for sure, you are going to die. So if term insurance is your strategy and you're buying it and you're buying term and investing the difference, all I ever used to ask people in the 80s when I started, like you said, how much term would you like and how much do you want to invest? Because they never had the money to invest and they didn't know how much term insurance they wanted because no one's ever told them how much they were entitled to have. You were very clearly illustrated that it's 30 times your income. Nobody knows that. Other than people that are listening to this podcast, most insurance agents don't know that. It's an entitlement product. It's a indemnification product. It only has the replacement value of you at work. It's like I say to people, you know, you've got a Rolls, but you can't insure for a Lamborghini. The car insurance company only allows you to insure for a Rolls.
Right.
But you'd love a Lamborghini if you totaled the Rolls, wouldn't you?
Sure.
So why can't you go buy insurance in the amount of a Lamborghini?
I think my Rolls is worth more.
Maybe. Well, a brand new Lamborghini off the lot might be a bit more than the Rolls, but you know you can't overinsure yourself. So the first thing that people will say is, "Well, I don't want to be overinsured." Totally impossible. Can't ever happen.
The insurance company's just not going to allow it.
Wouldn't allow it. The second thing is buy term, invest the difference is people who are living at a need level. And when you do a capital needs analysis, the way we're trained, you'll end up with a $1.4 million need. Most people, when they go and sell that insurance or the person buys it, don't buy the full $1.4 million, even though they're entitled to 20 times their income, even with the capital needs analysis being at 1.4. Because the next question that comes out of their mind is how much is it going to cost? The $1.4 million, that's a lot of insurance. It's going to cost a lot. And Limmer just did a study, and they interviewed people about insurance. And they overestimated the cost of insurance by 3 times, like 300%. They just don't know how much it costs because they actually haven't sat down with somebody to see what it costs to buy life insurance. And as you said, if I'm a wealthy person and I've got a non-registered account generating a T3 bill, and I can take that T3 bill away. How much does your insurance cost me by moving that money to a tax-free environment? The insurance is free, right? I can show you a scenario where insurance is of no cost in terms of your output of cash. It's just the government paying for it now because we've repositioned it into a tax-free environment. So it's those kinds of strategies that the Prime America and used to be A.L. Williams, and there's a few others out there that they don't show the client that. And they're selling mostly universal life level cost of insurance, or they're selling term insurance.
Well, and companies, and I'm not knocking Primerica. I'm saying be very weary of a company that only has one product to offer, and that is term. They have lots of mutual funds with high fees, but they don't even offer whole life insurance. So that's a little biased, and they're an MLM company, which I have nothing against MLM, but if you're really seeking, I think, true information from a licensed advisor, you should be able to deal with someone that has everything that they can offer you. I think the other problem with buying term and investing the difference is no one really ever invests the difference, because they might say, okay, you know what, I can invest another $500 a month, and they might do so for first couple of months until that, there's a sale at Louis Vuitton. Well, I can forego a couple investments, or I can pull something out. I think there's always gets to a point where it always interrupts, or they don't actually follow through with it.
Right.
Dave Ramsey will talk about you don't need term life in your 60s, because if you've been following my method and you're getting 12% every year in the mutual fund market, you become self-insured. What's the problem with being self-insured?
Well, then you're the insurance company, right? I mean, the problem with self-insuring is that you've just turned yourself into an insurance company, which is stupid.
And you're buying a dollar for a dollar.
Yeah. I mean, I was going to bring I should have brought the coins today. I was in a multimillionaire house in Woodbridge a few years ago. Yeah. And a really wealthy guy, owned a bottling company and some other companies. And we were sitting at this long table. It looked like Jed. Remember the Beverly Hillbillies?
Yes.
Where you walked in and there's the big staircase.
Yes.
He had two staircases, one on each side to the balcony, and this big sitting room where he had the fancy meals. So we're in there, and I went with another advisor, and I said, I'm going to show you exactly how to sell this. And I had a dime in my pocket, a quarter in my pocket, and a loonie. And I said to him, and it's an old Italian guy. So I said, you got any change in your pocket? And I knew that he would, right? This is about 10 years ago now, this particular situation. And he goes, oh yeah. I go, okay. Throw me a dime. So he brings out a dime, and I slip over a loonie. So he's got $1. So Ben Feldman used to say, build an estate for pennies on the dollar, right? Exchange pennies for dollars. So here's 10 cents for $1. Now he's got it in front. What happens in that moment, when I give you a dime and you give me $1, in that moment, money becomes real. We're not talking about the 1.4 that you're never going to see. We're not talking about a premium that you haven't paid for yet. We're talking real dollars. And as literal as this is, it becomes very real to the person. So I said, give me another dime. So I give him another loonie. And I go, how do you like this so far? He goes, I like this a lot. I said, how long would you like to do that? He goes, like you just said a moment ago, as long as possible. And I go, great. Because I got a company that has billions of these dollars, and you've got money to spend to put towards these dollars, and I can send you 10 cents on a dollar. Now, I got some bad news. At 85, you're going to wake up, and I'm going to come over now and take all those dollars away and keep your 10 cents. How do you like that? He goes, I don't like that so much.
Me no like that too much.
Yeah, exactly. He goes, I don't like that so much. I go, I got a tax problem. I go, I know.
You go, va fanculo.
Now, you could pay the tax problem with the dollars in your pocket, or you could pay them with these dollars. Now, I tell you what, give me a quarter. So he slides over a quarter, and I throw him a loonie. I go, how do you like that? He goes, not as much, but I still like it. So how far would you like to go with this? He goes, as much as possible. All I got to know is, how much would you like of my money? And how much of your money can you contribute towards it? It's like, I even got better news. Next year, you're going to have my dollar plus interest, right? how's that work? I go, well, that's how this life insurance works, right? And not only that, but if you live to 85, I had all these quarters in front of me, right? I slip him back all his quarters. I said, you've got my dollars and you get your quarters back and you get them back with interest. Now, how do you like it? Where do I sign? That was the next words out of his mouth, right?
Yeah.
So how much do you want? Ended up selling $1 million a whole life to a guy who was never going to buy insurance and only believed in term insurance.
Yep.
But realized in that moment that that's what we were talking about, right? There's another great story was Larry Kinlan, an advisor from downtown, from Toronto, used to work with lawyers downtown all the time. There's a lore in the insurance business. You might not have heard this one. So he couldn't get into this law firm. So they're finally down in Adelaide. They let him into the law firm finally, right? He goes to see his banker before he goes to the law firm, and he gets a briefcase full of cash, just full of bundles of bills, right? I think there was $50,000 or $60,000 in this briefcase. He takes it down to the law firm. He says, I've been having a hard time seeing you guys for such a long time. I'm a little upset. He says, well, what are you here to talk about? I'll show you what I'm here to talk about. And then like James Bond, he takes the briefcase. He goes click, click. That's all you heard in the room was these 2 clicks, right? He spins it around and dumps it out on the table. And then they see all this money coming on, like yours on your table now, but it's all cash, right?
Right.
He goes, that's what I'm here to talk about, money. Don't think of life insurance as life insurance. Think of life insurance as money. Money to be paid at a time that it's most needed, and you might not even be here to see the payment. That's what life insurance is.
Well, it's an asset.
It's definitely an asset,
Right.
a collaterable asset, as again, right?
Well, Garrett Gunderson says, purchase your net worth.
Yeah.
You're buying your future net worth for pennies on the dollar.
And the insurance companies say at the certain age, after your income earning years, you can only buy 1 times your net worth,
Yeah.
right? You've lost the window of that earning capacity, so there's no loss of earnings anymore. It's your net worth, so you can get 1 to 2 times your net worth.
What's the biggest lie that's become common wisdom in financial planning today?
Oh, I think your 12% rate of return is probably the most common thing. I mean, I got lots of bad things to say about Susie Orman and Dave Ramsey, and I have a PowerPoint presentation based on are Susie Orman and Dave Ramsey correct? And unfortunately, they're correct in a few things. One is you should have an emergency fund.
Yep.
One is you should not have a lot of credit card debt.
Correct.
You should not buy things you can't afford.
Avoid
buy
consumerism.
Don't buy things to improve neighbors
Yep.
you don't care about. Right? Don't care about you. Right? And so there's lots of and he has the baby steps, the 7 baby steps.
Yeah.
Right? So there's some really good things. The worst lie that he trains everybody, and he's got 50 million viewers listening to the lie that whole life is a ripoff and life insurance agents are here to steal your money. And it's just for them, not for you. And all of those things are not true. And the story about dividends are not true. Dividends are a refund of premium. That's true, right?
Yeah.
They're a refund of premium at interest. Because if I need to reserve enough to pay off the death claims I'm going to have in a particular year, and all of a sudden those people don't die, then I can afford to give back a dividend. So I do. And I can do it in paid up additions. I can do it in cash. I can do it however you want. But he doesn't talk about in 175 years now in Canada, there hasn't been a company that pays dividends that hasn't paid a dividend. They've always paid dividends. So dividends aren't guaranteed.
Through every recession.
Through every recession, every war, every
Yep.
Vietnam, North Korea, COVID, everything we've gone through, and everything we'll go through. Because they have to reserve so much money behind. Over 200% of the money has to be reserved in case there is a catastrophic incident where the insurance company needs to open the doors and start cutting the checks. And they have the money. As I said earlier in my comments, they're so big that if that happened, they have the money and no one's going to be shortchanged. So if that's true, then life insurance is the best financial instrument that was ever been made. It never goes down. Once dividends are paid, they accrue. They can't go below. They can't go down at all.
You can't lose it.
They compound additionally forever,
Yep.
like Nelson Nash said. You can be your own banker or bank on yourself. You don't need Wall Street, like your book says, Wealth Without Wall Street. You don't need to take any risks if you don't need to. At 69, I'm 69 years of age. John. 69. I mean,
You look great.
About my 40 years of being in the business. Thanks very much. 69 years of age, and I've taken risks in the market over that time. But now I'm starting to say, I don't really need to take a risk. And I have the life insurance as my reserve. I have a private reserve of money in my life insurance policy that if I spent my RIF out and lived in the world of abundance through my retirement and I died, my life insurance is going to replace all the money that my wife and I spent during that time. And she gets to spend it all again. So it's a pretty good product. And term insurance doesn't do any of that.
Well, you talk about it's never once an insurance company pays a dividend, it's vested. You'll
vested.
never lose it.
Never goes.
I had Ross Mandel on the show last week, and here's a guy who was managing hundreds of millions of dollars for people, and he said, "I've seen clients with $200 million portfolio, and within a couple of weeks." Be worth $2 million. Why?
Yeah.
Because Amazon went from $300 to $3.
Yep.
Enron went from $200 to $0. You know, all these companies that were committing fraud,
Yep.
they went to $0. Your money can go to $0. And he goes, I witnessed it. I watched billionaires become millionaires
Yep.
overnight
Absolutely.
because of a stock market. And a lot of people, I think a big mistake is people will compare life insurance
Right.
to an investment, which is wrong.
Which is wrong. It's the one of our other, Caleb Gilliam wrote the book and the and asset,
Yeah.
right? I always tell people, listen, it's not a choice between doing an RSP or not doing an RSP or not doing life insurance. It's not a choice. You need both. You need the RSP. If you want an RSP, buy your RSP or your TFSA and buy life insurance.
Yes.
Do your second property investment as an investment property to get, like Grant Cardone says, get nice steady income from your rental properties.
Yes.
But have life insurance as that and asset to back up. Life insurance corrects a lot of mistakes that you have made and you will make into the future. right?
Sure.
It brings money back that I've lost.
I think it's one of the greatest financial tools ever created to store your wealth.
Absolutely.
Instead of storing cash in a bank, you could store your cash in a whole life insurance policy, receive a dividend on it, and still get access to it without having early penalties, without paying tax on it. There's just so many great benefits of having the whole life policy, and it's not an either or asset. It's an, like you said, it's an and asset. I gave a speech last year at Circle of Wealth where I said, whole life insurance needs to be the heart of every financial plan. Have other products, have your real estate, have your CDs, have your bonds, be invested in the stock market. That's okay. Have your RSPs, your 401k, have it all around. Have your commodities, your gold, whatever you want, your crypto, have it all around, but have whole life insurance play the main character in your role.
That's right.
All the other products are supporting actors. And if you are set up that way, you cannot fail.
Yeah, I have another training PowerPoint presentation called Life Insurance is the Cornerstone to a Financial Plan. Right? It's just the cornerstone. Without the life insurance, everything else starts to crumble. Like the market, like you said a minute ago, the market can crumble. I saw, again, back about 20 years now, I was in Waterloo and I saw a client of an advisor. We went and saw this guy, Winston was his name, and he worked for Nortel. And we said, geez, where's all your RSPs? Oh, I just buy Nortel stocks. All my income, any residual income or discretionary income goes into Nortel. Anything else? He says, nope. Do you think you might want to? My wife worked at Bell Canada for 35 years, so I know the situation of Nortel and Bell Canada and what was going. And they had a split, and they allowed you to buy Nortel stocks. I go, this Nortel might not be the best thing, right? Yeah. And then Nortel did real when it was Northern Telecom, fantastic. When it went to Nortel, not so good. So then a year later, and he says, I have 1.5 million in my retirement fund. How much have you got? Right? I go, well, you might want to diversify. You do what you want, but you might want to diversify a little bit of this. I'm happy with it. Okay. Year later was after the crash. Nortel disappeared. We called him back when it was at $90, and he said, no, it's going to bounce back. We called him back at 60. No, it's all good. I heard some good reports. It's going to come back. I go. The next thing I heard, he had a heart attack and died, and his wife lost the house and was now living with her daughter. That's how that story ended.
And had they had life insurance,
they didn't have any life insurance.
they would have been able to probably pay off the mortgage, keep the house, and provide an income to the wife for however many years.
Yeah, they should have bought term and invested the difference because he died before 85. But
That's crazy. You know, you've delivered over 1,000 seminars. What's the one financial concept that people struggle most to accept, even after you show them the math?
I think the biggest one, and I'm going to be showing it in a couple of days at an Abacus meeting, is person A, person B.
Yeah.
You know, the alternative retirement in our circle of wealth system is that people believe that preserving the capital and living off interest on the capital is more efficient than anything else. It's the way to go. Because if I've worked all this time to save up this pool of cash, and now I've got, you know, cash coming from that cash, and it preserves my lifestyle, not realizing that it positions them in a world of scarcity. Because if they need more cash, they got to take higher risk. And you're now at a point 30 years later, 40 years later, where you don't want to take more risk. You want to take less risk. If you could have diversified your risk portfolio and had the same amount of income and then replaced all the income that you spent in your lifetime without worrying about ever running out of money, would you rather have that, or would you rather preserve that capital, live off the interest earnings? At the same time, inflation is eroding the purchasing power of those earnings. So you've got to, and if you don't have any emergencies where you need some of the money, like it's the worst possible philosophy to ever, that buy term, invest the difference, and then hold the cash and live off earnings from the cash is the worst philosophy ever invented.
Well, a lot of people also, they don't even grasp the concept of what's called the sequence of returns.
Right, that's right. Until they understand it really quick when they get hit by it.
Well, yeah.
See, this is the problem with like why I showed you the coin thing. I was going to bring some coins and show you that actually in practice, right? Because until you realize it, until it happens to you, it doesn't mean anything. You know, 2 years ago now, I guess this is coming to the third anniversary of the car accident of my family in Peterborough is coming up, right? And they didn't have didn't have very much life insurance at all. But we all think it's not going to happen to us until it happens to us.
Yeah.
And then it's too late. And sequence of returns, once you're in retirement at 72, 73, and you get hit with a 20% reduction in that pile of money that you were preserving to live off of, you're in real hurtville. You know, there used to be a phrase, still is, unfortunately. Financial experts agree, John, that only 70 to 80% of your pre-retirement income will be required during your retirement. So you're only going to need 70% of the money that you were living on before you retired. How do you feel about that?
I don't know if I like that's providing your home is fully paid for.
Absolutely.
You're debt free. But how many people actually retire at 60 with their homes fully paid for? Not very many.
Not
people.
many today.
No.
Zero. Like not zero, but very few, right? And then how many people are still in that home where they were in for the last 30 years? We don't do that. We buy the bigger home.
You're always
home.
upgrading.
We're always in debt.
Yeah, you're
live
trading
with
in for bigger, trading in for bigger, trading in for bigger. And when you do that, you're resetting the amortization tables again.
Well, not only that, you're setting your life. You know, one of the fallacies, again, the biggest lie, I guess, probably is this one, is that when we do a financial projection or plan, we've got to base it on two things. One is the rate of return, which we don't know. Ramsey says 12. Not happening.
Unsustainable.
Unsustainable. And the other thing is inflation. We say inflation is at 3%. I think it's at 1.2 right now. But a year ago, it was like at 5. So the average of inflation, since they tracked inflation, was, I think it's 3.9%, let's just say. Here's the lie. Your inflation rate is not 3.9. I seen your house. I seen your car. I see what you eat. I know your lifestyle. You're not living at a 3.9% inflation rate. Everybody's inflation rate is particular to them. So if you're prepared to go to Costco and have hot dogs instead of going to the local butcher and getting, ribeye steaks, top grade AAA, then you might be okay. You might be able to live, but not live a world of abundance. You're going to live in a world of scarcity and hurt. And inflation is going to erode any lifestyle that you do have. So I hope that you can live on 70% of your income, because that's where you're headed.
And I think that's another big mistake when we talk about a lot of these, the traditional advice is accumulate
right,
and live on 4%.
Well, who's that help? Who's that accumulation help?
The advisor.
Yeah, the investment advisor.
Yeah,
They
because
do now.
they're collecting the 1% fee.
Whenever you asked earlier about the banks and the investments in life insurance, I said the shaky part of that manager at the bank, like his shaky part of his life is getting somebody smart in his bank, selling life insurance, and eroding his capital that he's getting paid an MER on to manage. Because if I actually moved some of that money to life insurance and took away my tax bill, that hurts the bank, the employees at the bank, the guys with the sales contests at the bank. Everybody at the bank gets hurt.
It reduces their fees.
And the consumer doesn't know better, right? He's looking for a lower now. We've gone from 3.5% MERs down to 1%, like fees. There's still MERs in there, but there's still a fee of 1% to manage the money, right? So we're always looking for a guy with a discounted fee. But 1% on 6 is a good chunk of change. It's not like 1%. It's like if it was out of 10, it'd be a 10% fee.
Yeah.
If it was 1% out of 10 is 10%. And people don't understand. People don't understand money.
Oh, they don't. And they listen to too much, I call disinformation from guys like Dave Ramsey, where not all of his information is wrong.
Right.
It's wrong when it comes to whole life insurance is a scam because they're selling to you for the large, big commission. Let me tell you something. Life insurance agents get paid a commission one time.
One time.
If you're having your portfolio run by an advisor who's charging you a 1% fee, which I did for 17 years, I'm charging that 1% fee every single year. And you are accumulating because I've told you you need to save X amount of dollars to get to retirement. So you're putting away money every single month because I told you dollar cost averaging is good. That's right. So now you're putting in every month. This portfolio, your portfolio, hopefully is growing every single year. What else is growing? The fee. Yeah. I'm charging you a 1% fee, that's which is compounding. Right. At the end of 40 years, a 1% fee will erode your wealth by 1/3.
That's right.
Show me any insurance guy's commission that eroded your wealth by 1/3. It's bullshit.
That's right.
It's a lie.
It's one of those lies.
Right?
It's the phrase, if what you thought to be true wasn't true, when would you want to know?
Yeah.
And you want to know right away. But no one's there to tell you. I mean, a podcast like yours gives a lot of lessons about money and about wealth. And I'd advise anybody once they get hooked on your podcast to keep listening and watching it, because you'll learn a lot more than you will ever at education at high school or university. It's a joke. Like they teach you how to get a job. They don't know how to teach you how to do anything with the money once you get the job. They teach you how to get into debt because it gets you in debt while you're going to university.
Oh, yeah.
You come out of university in debt.
I've got my 13-year-old son reading my book, Wealth Without Wall Street. Why? Mm-hmm. He says, Dad, your books are boring. I said, let me tell you something. You read my book, and I promise you, you will know more about money at 13 years old than 75% of North America.
Yep.
Because they don't teach you this stuff in school. Why? They don't want you to know about money. They don't want you to know more than the banks, because when you start to really learn about money and how the game is actually played, you no longer need the banks anymore. And that's a bad thing.
That's a bad thing.
That banks want to keep you involved. They want to keep your money as long as possible. They want you to give it to them on an ongoing basis. Then they want to give it back as little as possible. If you ever want to test my theory on this, just look at the RSP.
Yeah. Well, and they can't work their system unless they have fractional lending, right?
Right.
They can't. It won't work.
And when you talk about the safety and security of an insurance company, you just said it, fractional reserve.
That's right.
If I put $100 into the bank only needs to keep $10. They can lend 90 out. Yeah. Where an insurance company, for every dollar that is invested, they have to have, was it $1.25? $1.25 in cash.
Yep.
For every dollar of death benefit that they have to pay out.
That's right.
They're
regulated to have that.
They have 125% coverage versus 10% at a bank. Well, this is why no insurance companies ever failed. Like even during the Depression,
That's
like
right.
1929, you had 9,000 banks that failed. Not one insurance company failed because of this model.
Well, you don't even have to go further than that. In Silicon Valley last year, right?
Yeah.
Like Silicon Bank, they overextend and they get themselves into real trouble real quick.
Yeah.
And they don't have the money in the vault. You can't go to the vault and ask for your $2 million. It's going to take a few days for them to get it.
Yeah. You and I talk about the great things that we do with people is we're not showing them how to take more risk in their portfolio.
Right.
We're showing them how to plug their financial leaks and be more efficient with their money. So for someone listening who has a traditional financial setup, what would be the first financial leak that they should look for in their own finances?
Well, they should sit down with somebody like yourself. I mean, you gotta go over the places where there is leakage, but the number one spot where there's leakage is in credit card debt, and people don't realize the cost of lost opportunity costs. So, and then the other thing is spending patterns. Like you have to change your spending pattern. If you're in credit card debt and you've got multiple credit cards, you're kind of already messed up, and you need to be cured. So, what the normal course of action for a bank was always, well, let's give you a debt consolidation loan, pay off the high interest credit cards, 29%, 27%, 25%, whatever you got, put that down into a 5% loan on your bank and have a line of credit loan. And we could even put it against your house. So let's get your house into debt and do that. And what happens with a person who is a spend first person is that 6 months to 7 months later, the credit cards are going back up. Now the loan has to be fed. And the line of credit in the house might be going back up because they treat their line of credit on their house like an ATM. I've got relatives that I mistakenly gave a relative a Manulife One, and they had a $120,000 mortgage, and I thought, well, if you get the Manulife One, you'll pay it off quicker. And it's 15 years later, the mortgage is $265. And they've got credit card debt. They treated that mortgage, or line of credit, like an ATM. Their wants exceeded their needs, and they went crazy. They flipped a car. They had a car for 2 years and decided that they didn't need the Tucson. It was too old, so let's get a new one. And the girl was calling, oh, your Tucson's 2 years old. You should get a new one. Well, I haven't paid off the first one. Oh, that's okay. We'll fold it into the second one, and you will just carry on the same payments. So instead of like 8 years, it'll be 10. There's no big deal. He goes, okay. So no additional out-of-pocket expense, though, right?
Yeah.
In my immediate hurt, but long-term hurt, big time, right?
And they're spending their future dollars. They're spending future earnings.
That's right.
For today's lifestyle, and that's where Dave Ramsey does get it right, and Susie Orman.
Yep.
Don't spend for consumerism,
Right.
unless you got the cash to pay for it.
Correct.
And I say you should be able to pay for it twice over.
Yeah, exactly. Well,
Right?
the other thing is, the one thing, I just heard something posted a couple days ago. I was watching one of an advisor in Toronto, and she was coming up with this financial literacy. So she got an article posted to one of the magazines, right? It's a great article. And it was about the emergency fund. You got to build up, like Ramsey, you got to build up an emergency fund, $1,000. But if you don't have any money, it's hard to build up an emergency fund. So here's what you should do. You should put in like $10 a week. So at least in a month you'd have $40. And then you should stop doing a few things like the old Starbucks coffee or buying something. So now I'm not only living in a world of hate later, now you want me to live in a world of pain today, which is probably true. I mean, we need to restrict back a little bit about our wants, hold back our wants a little bit and get an emergency fund put in place. My argument about it is life insurance is an emergency fund. Like if I really needed money in an emergency, and then it goes on to say, all of a sudden you'll have $1,000 as an emergency fund and you'll want to take a trip. Talk yourself out of taking a trip. Who do you know that once they get their head around, I want to take a trip, talks himself out of getting that trip? They're going on the trip. And a savings account is too easy to get at. John Savage used to have a presentation. I've got it printed out actually in a video of it. It's called 3 Tin Cans. You got to look it up. 3 tin cans.
Okay.
This one tin can, you can't open it up. It's like the water you gave me earlier, right? The water's going to last a long time if I can't open the tin can, right?
Yeah.
So this was the whole life. So if you need it in an emergency, you can borrow against the tin can. But other than and you got to call me to do it. And when you call me, I'm going to dissuade you from getting at the tin can.
Right.
Trouble with the TFSA? I've done some studies recently, again, for this presentation coming up. What do you think the maximum deposit, the average deposit to a TFSA is in a year?
In a year?
By Canadian. On average.
On average, I'm going to say about $2,500.
About $2,000. What do you think the average contribution to an RSP is for Canadians in Canada today?
1,800.
3,900, a little higher.
Okay.
Who do you think maxes out the TFSA and the RSP?
Nobody. Or
The 1%.
with the millionaires. Yeah. The guys who are earning probably 200,000 plus because they've been taught
Correct.
to think
By
the banks and financial institutions
and their accountant.
yeah, and the people who promote RSPs
Right.
that you are going to save tax.
Yeah.
Wrong.
Right.
It's a lie.
Postpone.
You're not saving tax.
There's no tax.
You're postponing the tax because it's not called tax forgiveness.
No, that's right.
Okay.
It's like,
You're postponing the tax, and you're also postponing the tax calculation to some time down the road where you don't know what the tax rates are going to be.
yeah. But the lower end of the scale, people making $50,000 or less a year, which is 10 million people in Canada, right? 10 million people in Canada make $50,000 or less a year, living in that world of scarcity. Now you're going to try and convince them to start a savings plan at $10 a month. Not that that's a bad idea, but how about we protect them and create a savings plan at the same time?
Yep.
Have a conversation about double duty dollars, right? If I had double duty dollars that provided the and asset, it provided some insurance and access to cash. If I actually, if my fridge blew out and I didn't want to put it on a 29% interest credit card, I could collateralize my life insurance policy, take a short-term loan against my policy, and then, as Nelson Nash says, put the peas back into the grocery store. Don't steal the peas. Pay the money back to my insurance policy, add interest, and then I'll be able to do it again when the next emergency arrives. But all the time, I'm covered by insurance. If a bad thing really happened, right?
Yeah. Listen, I have a moniker. It's live 50, 30, 20.
Right.
The 20% is your savings and investments, right? You should be saving 20% off the top, pay yourself first. But a lot of people go, I can't save 20%. Mm-hmm. Okay. Can you do 5%?
Right.
Can you start at 5%? Can you start at 3%?
Right.
And then maybe every quarter increase it by 1%.
Yep.
Challenge yourself to increase it by 1% a quarter or 1% a month until you're able to get to that 20%. Because if you gather all these little wins and you're able to do this, little wins equal big wins. And you'll notice without needing to sacrifice your latte, I love what Ramit Sethi says. He says, that's bullshit. Like sacrificing a latte, I'm sorry, you're going to be fucking miserable.
Yeah, exactly.
Okay?
Yeah.
That doesn't work. If you really want to save, find out where you're making large purchases, like the credit card, interest on a credit card. That's going to cost you more than your lattes or $3 a day. But gather those little wins and you'll get the big wins.
So there's nowhere I can see that. You see, the problem we have with that example right there, and I use that example again in all my training, is that 29% at interest in a credit card. What is it? They don't know.
Yeah.
They don't know they don't know their life expectancy. So let's say we go to 85, but 29% on $10,000 for the next 30 years is an awful lot of money. But even saying it's an awful lot of money, leaves it in that nebulous area. Like, I don't know how much money. When I actually see it with that future value calculator in our software or the lost opportunity cost calculation, and I show them the number, that's the number. My wife a few years ago, and we just did it again, and she put an extension on our house. We had a deck on our second floor we never went out to. So she says, what would be really nice out there is a walk-in closet. And I go, well, that would be nice. And then while we're doing that, it'd be really nice to get the bathroom redone because the guys are going to be here making a mess anyway. So so I go, okay. So the closet costs us, I think, $30,000, and then the bathroom was another $12,000. So there's $42,000. But in the back of your head, in the back of my head today, I think that's $42,000 at 6% to my 85th or longer birthday. So I did the calculation, and it's $150,000. So that closet's going to cost us $150,000, not $30,000. And we just moved to we left that house after the renovation.
And for my listeners, it's because of what's called opportunity cost.
Opportunity cost.
Opportunity cost.
It was in my, We drained a little tank, right? And we paid the man to come and do it, and it was gone. So it's not in my hands anymore. It's in his hands, and he's feeding his family with it. But I'm losing that money for my future at 6%. I'm just saying 6%. It's been about 6.5, let's say. And for the rest of my life and my family's life. We moved to another house. We stayed in that house 1 year after that was done. My wife, I said, well, I hope we get an extra $150,000 out of that rental because that money's staying behind.
Yeah.
So then we got into the new house. Well, we wanted to downsize. So we did. Then we built we had to redo the garage. So we tore down the garage that was there and we built a 2-story garage with a coach house, like a coach house on top. Another $125,000. Well, in your head and my head, that's not $125,000. That's $125,000. We drained the profit from the sale of the other house, a bit of that profit, took it out of an interest-bearing account and put it into this new addition at 8% for the $125,000. Now do that calculation. And when you do that calculation, when we sell the house next time, I got to come up with that difference. I got to make up that difference.
Yeah.
Because that's what it cost me. And that's one of the fallacies that, one of the biggest fallacies is your example earlier about, I want that latte. I want that Starbucks. Well, that Starbucks is $6 today. If I only bought the Starbucks coffee, if I bought something else to go with it, it's 10. I can go to Tim Hortons for $2.95 with a donut and a coffee. But we never rationalize it. And we don't go, okay, that's $6 every 2 days. That, the young lady who posted this article saved $10 a week. If I just did that, I would be much better off than had I not done it.
Sure.
But show me the numbers. Show me the numbers. And when I start to feel it, like you said earlier as well, the little wins, One of the things that Ramsey and Susie do have is that, you start to build that account, and then you get to look at that account and say, oh, look at that. Our credit card might be at 29%, but at least we have $1,000 saved up.
Or the debt snowball.
Yeah.
You know what? Pay off the small one. You say, oh, man, I got this done. And you take all the money, you go to the next one and the next one. Going back to your credit cards at, say, 19, 21, or 29%,
yeah.
I think a big problem with these credit cards is on the front page, you see minimum payment. And they go, oh, this is all I got to pay.
Right.
But then if you look at the next page, how many people look at the next page?
Nobody
Right.
looks at everyone looks at the minimum payment.
They just look at the minimum payment. But the next page will show you if you only made the minimum payment, it's going to take you 29.4 years to pay this thing off.
Yeah.
No one ever looks at that.
No.
If you only made the minimum payment, like who's making the money? They're making a shitload of money here. Let's talk about velocity money. Let's talk about velocity money versus accumulation of money, because banks will tell us to save, accumulate money. But that's not what they do. So they use a theory called the velocity of money. What's the difference, and why don't they follow their own advice?
Well, actually, some of them do follow some of their own advice in terms of the insurance component, because they do insure executives. And there was a big thing a few years back about Walmart. As soon as you get hired as an executive at Walmart, they put a life insurance policy on you. So they do the Rockefeller routine with some of their captive people, right? In terms of velocity of money, they do, though. They buy real estate properties. I mean, you see a lot of the insurance companies do,
but they don't save money. The banks don't save money. They don't accumulate.
No. They're not making velocity of money by saving money. They're lending it out to you at 10 cents, like you said. I got 10 people coming to me for $1.
Right.
I'm lending it out to them to get in debt, and that creates my velocity of money on my side. What they do is invest in properties, or if there is they used to, Cadillac Fairview used to always be invested by a bank or an insurance company or something. You can see buildings going up. This building funded by whatever institution it happened to be, TD Finance or whoever, right? So they do some of that, and they make way more money on your other example on credit card debt. They can't make 29%. It's not that these people forego their loans. They want you to pay that loan, and they want to help you pay that loan. But they want to help you pay that loan at 29%. Your first come on and join us is 19. Or sometimes 6.5% for 6 months.
Introductory rate, 1.99%.
Not see that.
And then take a look
Then at the 6 month mark, you go, oh, you've still got some debt on here. Yeah, because it cost me nothing to buy it, so I bought it. I go, okay. So now you're buying you're selling your future for your present.
Yeah.
And then you go into that, oh, you missed a payment. Oh, I forgot. Oh, that's okay. Now it's
$24.99, 24.99%.
24.49.
Yeah.
And it's like, oh, I missed 2 payments. It's like, oh, now it's 29.9.
Yeah.
Well, how do I get back to the 24.9? Oh, no, you don't. You haven't paid off your debt yet.
Yeah.
So until you pay off your debt, we're not bringing you back down to zero and start you back over. And we probably won't do that because you're a bad risk. So now you got to go to, now you get these cards. Amex is traditional, notorious for this. Introductory rate. Float your debt at BMO over to us, and we'll pick it up, and we'll only charge you 4.5 for the first 6 months. And then you better read the fine print. Because Amex is one of the ones, if you don't pay it off by the end of the month, you can have it for free for 15 days. But if you don't pay it off by the pay date or by the end of that month, you're getting whacked on the whole thing.
Yeah.
Not just on what you bought that month.
Yeah.
So whatever you bought on sale just cost you twice as much as it would have had you not bought it. Well, if you had not bought it at all, it would have been better off. But nothing's on sale. Everything you have on your credit card, you never got it on sale.
I watched a video on Dave Ramsey, and someone talked to him. They called in the show and they said, banks they own life insurance. And Dave Ramsey came out and said, banks do not own life insurance because they're not that stupid.
Yeah, well,
remember,
some of his stuff is not quite true. Right?
I could show you, Dave, where banks own over $200 billion worth of it. Bank America's got like 20 billion of bank-owned life insurance, and they buy it because they can use tier 1 money.
Yeah.
Right?
Well, they're buying it with your money on deposit, right?
Exactly. How has Wall Street convinced us that taking more risk equals more reward?
Well, they show you ledgers that show you that. I mean, they show you again. You got people like, unfortunately, I know Dave Ramsey's. I forget what's the mutual fund company that he's
compensated.
Yeah, he's
quite
sponsored
well
by a mutual fund company. I can't think of the name right
Yeah.
now, but they want you to invest to get that hypothetical 12%, right? Because it's the illusion of the dream. I mean, it's the dream. I can put my money away. I just saw something recently on TikTok. My son calls me one night. He goes, "Hey, if I put $100 a month away at 13%, in 10 years, I'm going to have $1 million." I go, okay.
First of all, where are you getting the 13%? Because I'll put all my money there.
Let's do the paperwork tomorrow. What's he investing in?
right.
Oh, it's just in the market. He's got a diversified portfolio.
okay.
I go, tell you what, I'll be over tomorrow afternoon and we'll write the paperwork up and we'll get going. Like, why would we not do that? And going, oh my God, man. But the problem is it's out there for everybody.
Yeah.
You know, you can go on TikTok right now or YouTube and see a pro infinite banking video. Or you can go 2 episodes later to find a anti-infinite banking video.
Yeah.
You can hear Dave Ramsey talk about, infinite banking, it's a lie. It's a lie. There's no way that ever will work and all this kind of stuff, right? And you can find somebody else that has the polarity of the world right now in this election going on today. It's like you're Republican or Democrat, and they don't talk to each other. Like there's just, you're either with me or you're against me. There's no happy ground. And Ramsey's like that. There's no happy ground. Say, listen, whole life's not a bad deal for lots of people. It's not a great deal for poor people. Like poor people that are making $50,000 or less should have some permanent insurance. But I don't think they should put 35, 40% of their money into it because then it's trapped inside the policy, but you can collateralize it and everything else. But
yeah. So beyond the death benefit of a whole life policy, how are your clients using whole life insurance in most ways that people haven't even thought about?
Well, a lot of them are they're using it to invest in real estate. They're using it for a capital purchase. I've got one right now. He's doing a business venture. We just did the deal. It's funny. We just did the deal Friday. We closed the deal Friday in London, Ontario, and picked up the check, right? So he wants to collateralize it like Monday to put into a business venture because his accountant and he have looked at it all over and said, listen, this is the best use of our money possible. You know, we gave them the money. It's in the policy. It's growing in the policy, and yet we collateralize it and we invest in this business, and the rate of return on this business is supposed to be 18, 19%. Well, if it happens the way he says it's going to happen, it's a fantastic deal. He's paying to borrow the money, but he's paying it back to himself.
Right.
Like, it's amazing.
Yeah. So you've trained thousands of advisors. what do few understand or teach wealth protection strategies versus just wealth accumulation? What are you finding is the biggest problem? Because you said you're out there on the road with guys that have been in the business 5 years, 10 years, sometimes 20 years. What are you seeing that you're teaching them that they don't even know about wealth protection strategies?
I think the biggest thing is that there are more people out there that want it than there are advisors that are putting it in front of people to buy.
Right.
So I think that it's back to that confidence issue I talked about. I'm seeing lawyers downtown Toronto, real estate owners and business owners that are prepared to cut you a check for $100,000 because they realize I'm just moving it from this account to this account and I'm picking up life insurance. Yeah. And I take away the tax bill on that account. Yeah. And I still have access to the cash. Yeah. They can't believe it. So two things happen. One is, if it's so good, how come not everybody's doing it?
Right.
Well, I always turn to them and say, I haven't seen everybody yet.
Yep.
Right? And if it's so good, why isn't everybody doing it? I've never heard about it before. Because you're not talking to the right advisors. You're talking to the advisors who are based on the accumulation theory.
Right. Where are you getting your advice from?
You're getting your advice from guys that have been around 25 years. The people that are out there that are 25-year trained, 30 years in the business, were trained incorrectly. Like I'll do a seminar. I'm going to be doing it again, like I said, on the 13th. First question I ask is, hands up if you believe dividends are not guaranteed in a life insurance contract. Put your hands up. And I know half the room is going to have their hand up. And they're life insurance advisors, CLUs, CFPs. I go, it astounds me. I go, and they don't understand that I can have additional deposit option. Like they were sold how to sell whole life by their insurance carrier, London Life or Canada Life or anybody Life. Whole life is good. Whole life is good, but it's better with the additional deposit option because any additional deposit option is like a TFSA deposit on steroids because it's inside the contract, protected from the markets, and it gets the same dividend crediting as the base policy.
Yeah.
No one knows this.
Yep.
No one knows this, and they're in the insurance business and have been in it for 25 years.
And if you own it corporately, that's just another way for you to get more money out of your business tax-free.
Well, that's just astounding. Like, first of all, your after-tax earnings rate in your company is a lot less than your personal tax rate. So now you're paying for it with discounted tax dollars, and you still have access to all the cash and all the facility of the collateral opportunities. So it just doesn't make any sense for. And the other thing I'll notice too is business owners don't understand what a holding company is. It's amazing to me that accountants don't talk about holding companies to their clients.
Yeah.
Like, and you'll run into it because you sell real estate. Well, the guy's got a couple of real estate properties, but he owns them personally, or he has a company that he owns them, and he has other assets as well. So you don't own these other assets in another company under your holdco? What do you mean a holdco? What's a holdco?
Yeah.
I go, you're kidding me, right? How long you had your account? Oh, he's been with me for 30 years.
You should fire him.
Boy, you've been getting bad advice for 30 years. And the phrase that I love that Trent Fortner gave us was, how much longer do you want to overpay Revenue Canada?
Mm-hmm.
Right? And they go, what do you mean? And then you show them, and it's like they can't believe it. And then they say that line, well, if it's so good, how come not everybody's doing it?
Well, again, it goes back to where are you getting your advice from?
Susie Ramsey. Dave.
Yeah, exactly. Or your financial advisor, you went to him and said, should I get life insurance? No, you don't need life insurance. Maybe just get a term policy. Yeah. And the reason why they're telling you this is because if you were to take $10,000, each year or $5,000 out, they're losing money. So they're not
1% on.
They're losing 1%
every year,
and it's not in their best interest. That's why I left in 2016.
Yeah,
I realized that this is the wrong advice.
Not only that, I mean, I when I left Canada Life, I left as an employee. I was doing some work for Canada Life, and I had a pension there. I did some illustrations on the funds and everything else, and I'll move the money from the pension into the funds, and I'll be way better off by the time I'm 65 than if I'd left it at the pension. Well, the pension was doing 9%, right? The pension was doing 9%. Still, I put it in some funds. So I went up to 18 on some of those funds, and I went down to minus 30 on some of those funds. I've averaged 3.4% on those funds.
Trying to do it yourself.
Good move, huh?
Yeah.
It's like,
leave it with the professionals.
Let me tell you.
So we're about running out of time. What are some books that you would suggest that if people really want to learn how to create more wealth and really understand the basics of, life insurance as an asset, what would you recommend besides my book?
I was going to say you've captured a lot of what those people say in your book. There's a really good guy, Darren Mitchell, out of Nova Scotia, that's with our company, and he's written a book called the Be the Bank.
Yep.
Be the Bank. I would probably look that up on Amazon. Be the Bank. What Would the Rockefellers Do by Gunderson. You mentioned Gunderson a couple of times. Garrett's got some great stuff. There's a couple of books he's written that I don't think are great. He got into kind of a human resources thing.
Yeah, Killing Sacred Cows was really good.
Killing Sacred Cows was dynamite.
New York Times bestseller.
His next book, The Rockefellers, great book. But Killing Sacred Cows is a great book. The And Asset by Caleb.
And I'm reading one right now called, I'm actually almost finished. It's really good. It's called Permission to Spend.
I got that book as well. Yeah.
Great book.
Yeah, that's an excellent
Really
book.
good book.
And
I'm
I use
almost
that phrase all the time. I mean, that's what life insurance is, right? It is that permission slip to spend your other assets.
Yeah.
And no one showed anybody that, while I'm spending that RSP down or my RIF down, that life insurance value just keeps growing up. So when it's down at zero, I've timed my estate, my RIF to be at zero at 85. If I'm still here, I want it at zero because I want to spend it with my wife while I'm healthy and alive.
Yeah, balance that last check.
And that life insurance is going to be there to save me at 86 when I go get that reserve and collateralize that. I can collateralize that, or I can collateralize my house or do a reverse mortgage. There's other opportunities.
Sure.
And what I always say is life insurance is going to create opportunities for you in the future that you haven't even thought about yet.
Yeah.
Right?
Yeah.
What if the next thing, not Bitcoin, but the next thing is the best thing that's ever come along? And I need access to collateral capacity to invest in it. Life insurance is my guaranteed winning ticket.
Yeah.
All right?
What's the one piece of money advice that you know today to be true that you would give yourself 60 years ago or 50 years ago?
Two things. One is buy more permanent insurance. That's the first thing I would have done. And the second one is this, and it's going to sound weird, but there's a guy named Len Renier out of Detroit, and he wrote a book called Legacy. There's another book called Legacy.
Mm-hmm.
And you know how your kids are a little bit young, your son's a bit young yet, but your child gets to be 21, gets his first job. What's the first thing he's going to do? He's going to start an RSP.
Yeah.
Because the bank's going to tell him that's what you should do. And I've told my kids, what you need to do is buy a life insurance policy on me. Don't do the RSP. Put $300 a month, $500 a month into a life insurance policy, pool it all together, put $500 each into a life insurance policy on my life, and be guaranteed the certainty of its paying out on my death. Because two things are certain. It will pay out, and I am going to die. And if you can benefit from my death financially, there's no reason why I don't want you to.
I bought a policy on my mother, I'm going to say about 15 years ago when she was younger, in good health. Unfortunately, today she's 72 and experiencing Alzheimer's.
Right.
And she would be uninsurable today.
Correct. Yeah.
So I was able to purchase a decent sized policy on her 15 years ago, and I bought a term 100.
Yeah. Yep.
So I know that's never going to go up. She's going to have it to 100.
Yep.
And people go, "Oh, you're going to profit from your mom's death?" I'm thinking, I'm not going to profit from it. But here's the other question: out of all my sisters, I said, who's going to pay her funeral costs? Who's going to pay for her burial? It's none of you guys. It's me, and I'm going to pay it out of the life insurance policy.
Right. Well, that 10 cents on the dollar that I showed you earlier, right?
Exactly.
It's like, and I don't care if they profit from my death. That's a good thing. Like, if it's like when people are anti-term or anti-whole life and pro-term. I said, well, it's kind of interesting. When's the last time your term insurance gave you a refund of premium?
Yeah.
Like a dividend. They don't give dividends. They don't give you, when all the people that bought it died. Matter of fact, we know none of them did. Less than 1% of them did.
Yeah.
So why don't you get some of your money back? Didn't cost the insurance company anything. They didn't die. And by the time they do die, it'll be out of force. So it's never going to cost the insurance company any money. Or very, very rarely is it going to cost the insurance company money for them to have you have term insurance. It will always cost them money for you to have permanent insurance.
Yes,
Always.
exactly. Don, we're about out of time for today. This has been a really great conversation. I hope my listeners really got a better feeling and an idea for what life insurance can do for you and the different types of life insurance. So thank you so much for your time and for coming here.
Thank you, John.
Guys, if you like this episode, please subscribe. Share it with a friend who you feel that would benefit from the Wealth Easy Show. We talk all things wealth, health, and real estate. It's not just about life insurance. We teach you how to create wealth. And guys, my book, Wealth Without Wall Street, this is the type of information that you are not going to learn in school. It's available online at Amazon. It's in chapters, Barnes & Noble. Pick it up. You're going to learn more about wealth than most of the country is going to understand about money. It talks about plugging your financial leaks and being more efficient with your dollars. That's all for today. Take care of your wealth and your health.